Gold's meteoric rise, a safe haven in turbulent times. In October 2025, gold prices have surged past $4,000 per ounce for the first time in history, marking a significant milestone for the precious metal. This unprecedented rally is drawing attention from institutional investors, billionaires, and retail traders alike. What was once considered a defensive asset has become a central topic in global investment discussions, signaling shifts not just in portfolios, but in broader economic strategies. The rally has been fueled by a combination of geopolitical tensions, economic uncertainties, and strategic portfolio rebalancing. For many, gold is no longer just a hedge, it's becoming a cornerstone of wealth preservation in a volatile world. Global factors driving gold's ascent. Several interconnected factors have driven gold's sharp ascent in 2025. Understanding these forces helps explain why investors are flocking to this traditional safe haven. Geopolitical tensions. Ongoing geopolitical conflicts, particularly the Russia-Ukraine war and rising instability in the Middle East, have prompted investors to reassess risk. Historically, gold has thrived in times of geopolitical uncertainty, as investors seek assets that maintain value when global economies falter. According to analysts, nations stockpiling gold and individuals purchasing physical bullion are acting on the perception that gold is immune to political turmoil, a perception reinforced by decades of historical performance. Economic instability. The U.S. government shutdown has added another layer of uncertainty to financial markets. Entering its seventh day, the shutdown has restricted access to key economic data, leaving investors and the Federal Reserve with limited insights to guide monetary policy. With a lack of clear economic signals, investors have increasingly turned to gold as a store of value, hedging against both short-term market volatility and long-term systemic risks. The shutdown has exposed vulnerabilities in the financial system, reminding markets of the need for safe haven assets. Monetary policy shifts. The Federal Reserve's monetary policies continue to play a critical role in gold's rise. Expectations of interest rate cuts in late 2025 have weakened the U.S. dollar, making gold more attractive for international and domestic investors alike. A weaker dollar increases the purchasing power of foreign buyers, which has been reflected in record-breaking inflows into gold ETFs and rising demand from central banks globally. These trends indicate that gold's rally is not merely speculative, but supported by solid macroeconomic fundamentals. Institutional investors embrace gold. Billionaires and institutional investors are now actively increasing their exposure to gold, signaling a profound shift in traditional portfolio strategies. For years, portfolios heavily favored equities and bonds, but gold is now emerging as a core component in risk mitigation strategies. Morgan Stanley's 60/20/20 portfolio. Morgan Stanley has proposed a modernized portfolio allocation model, replacing the conventional 60/40 stock-to-bond ratio with a 60/20/20 framework. 60% equities, allocated to stocks for growth potential. 20% bonds, providing stability and income generation. 20% gold, acting as a hedge against inflation, geopolitical risk, and market volatility. Mike Wilson, chief U.S. equity strategist at Morgan Stanley, explained that the gold allocation can serve as an insurance policy for traditional portfolios, protecting investors during periods of economic uncertainty. This guidance highlights the growing recognition among institutional investors that gold is more than a decorative asset, it's essential for long-term portfolio resilience. Goldman Sachs bullish forecast. Goldman Sachs recently raised its gold price projection to $4,900 per ounce by mid-2026. The bank cites a combination of Western ETF inflows, central bank purchases, and persistent U.S. dollar weakness as key drivers of this surge. The bullish forecast has been echoed by several hedge fund managers, including Paul Tudor Jones, who advocates a diversified approach combining gold, crypto, and technology stocks. Jones predicts that these assets will maintain long-term value while traditional stocks face volatility. Billionaire perspectives on gold. Gold's rally has not gone unnoticed by some of the wealthiest investors in the world. Ray Dalio, founder of Bridgewater Associates, recently advised holding around 15% of one's portfolio in gold. He emphasized that gold is one asset that does very well when the typical parts of the portfolio go down, underscoring its protective qualities. Ken Griffin, founder of Citadel, expressed concerns over a broader move away from the dollar. He noted that investors are effectively de-dollarizing or de-risking their portfolios in response to perceived U.S. sovereign risk. Such statements indicate that gold's appeal extends beyond mere profit. It is a strategic response to systemic risks. Market dynamics and equity interactions. While gold soars, equity markets are showing mixed signals. U.S. stock futures, including the Dow, S&P 500, and Nasdaq, have experienced modest gains, reflecting cautious optimism among investors. However, concerns over overvalued tech stocks, AI-related investments, and cloud profit outlooks at major companies like Oracle have caused temporary pullbacks. This divergence highlights a classic investment scenario. While equities may offer growth, gold offers protection. Analysts believe that this dynamic is creating a self-reinforcing trend, where more investors allocate to gold as equities face headwinds. Gold performance metrics. The SPDR Gold Shares ETF, GLD, one of the most popular vehicles for gold investment, is trading at $366.26 as of October 8, 2025. Central banks continue to purchase gold at record rates, with annual global purchases exceeding 1,000 tons. This combination of institutional, retail, and central bank demand is creating a robust support level for gold prices, making it one of the most resilient assets in today's financial landscape. Considerations and risks. While gold offers multiple advantages, investors must remain aware of potential risks. Volatility. Despite being a safe haven, gold is not immune to short-term price swings. Changes in interest rates, monetary policy, or geopolitical events can trigger rapid corrections. Overbought market. Some analysts warn that gold may be entering an overbought phase, with potential for short-term pullbacks. Diversification importance. A diversified portfolio remains crucial. Overexposure to any single asset, including gold, can increase risk rather than mitigate it. Historical perspective. Historically, gold has demonstrated a consistent ability to preserve wealth during periods of economic uncertainty. From the 2008 financial crisis to the U.S. debt ceiling debates, gold has repeatedly acted as a hedge, outperforming equities and bonds during turbulent times. The 2025 rally aligns with these historical trends, reinforcing gold's role as a cornerstone of strategic investment planning.